Welcome, everyone. I'm Steve Lowry, the Executive Director of AInBC, and today we've got an amazing guest with us to help us learn the ropes of raising financing for your startup. I've got Russ Armstrong, VP of Sales and Strategy at Boast.ai. He's going to tell us about his experiences raising all kinds of funding, from angel money to VC funds to non-dilutive financing such as debt. He's got a ton of info to share, and I'm really looking forward to jumping into the conversation. First, I just want to let you know we'll be doing a prize draw as well after the event. So for everyone who had attended, we'll award a one-year subscription to SlideBean, and that's sponsored by Boast.ai. SlideBean is a cool tool that has a bunch of templates of like household name startups who've been really successful. You can take their pitch deck and work with that as your starting spot as you're crafting your story for investors. So we've got a bunch of neat tools that we'd love to bestow on one lucky recipient as we do the draw. Now, before getting to the conversation, I think I'd like to just give you a little context for the webinar by introducing AInBC and my guest. So AInBC is British Columbia's industry body for AI. We support companies, academic institutions, and the provincial government in building an AI ecosystem that will drive our economy forward and raise BC's profile for innovation globally. So if you're a company using machine learning or artificial intelligence and you're seeking capital or talent or customers, love to hear from you through our website at AInBC.ai. And we'd also invite you to become a member of our growing community. As I mentioned, I'm the executive director of AInBC. Been in the tech industry about 15 years or so and raised a number of financing rounds myself. But today our focus is on our guests' fundraising experiences. Russ Armstrong, as I said, is VP Sales and Strategy Boast.ai. And Boast is a venture-backed company that helps startups with the pain points of finding and properly filing and doing accounting for billions in R&D tax credits and innovation incentives across Canada and now more and more in the States as well. They're developing AI to hugely streamline this process, and they provide non-dilutive capital to startups they work with to fuel growth while preserving equity. And so Russ hails from the world of finance, where he spent 11 or so years, I guess, in algorithmic trading at RBC before trying his hand at entrepreneurship, where he's accomplished a lot. Russ co-founded Limelight Platform, which was the world's first experiential marketing cloud. He ran sales, finance, and operations there for 5 years. And in that time, he and his partner secured funding from Sandhill Angels, Round 13, IGAN, Excela Prize, and others, totaling over $10 million USD. He's now working with other entrepreneurs to help them fund their big ideas through Boast's platform. So welcome, Russ. How are you doing?
Yeah, thanks very much for having me. Fantastic. Yeah, I'm doing well. Excited to share some insights here today.
Oh, absolutely. Yeah, I can't wait to get into it. But first, let me congratulate you and the Boast team on your two big pieces of news on financing. First, you had the $23 million USD Series A, and that was followed by like $100 million credit facility for providing non-dilutive financing. So congrats on that. And how's the team feeling these days? What's it like over at Boast?
Yeah, no, fantastic. Thanks very much. Interesting. We a bootstrapped company up until we raised that money. So founded in 2011. We've been around for a while, and I joined the team myself in late 2018. So I haven't been around from the start. But the founders, they were working through it, bootstrapping it, growing it from a small base to what it is now. So you think about that. That's 10 years of pretty much bootstrapping before we raised a Series A. So sometimes that's the natural course, and really just depends on the type of business you have. And I think that's an interesting lesson. Like, not all businesses need venture capital right away. And sometimes you hit a milestone or a turning point where you decide to take on capital. And, that was the Boast story. 10 years on, we decided to take on some capital to grow faster.
Yeah, it's the 10-year overnight success story, right?
Yeah, exactly.
And so what was that? I'm just curious, that opportunity that saw you kind of, push the pedal on the gas in terms of, the non-dilutive funding space. What are you going after that needs that capital, I guess?
Yeah, you know what? It's kind of interesting how you approach these things. I mean, the space Boast was in is, been around since the 80s, the market, the R&D incentive space. It's been around a long time, but there's been zero innovation into it. There's been zero venture capital in it. And it was around 2017, 2018, when we started to build software to try and automate the workflow around it. And I think that's one of the lessons, you see this all the time. People disrupt themselves. At Limelight, where I was a founder, we were disrupting ourselves. We spun out of an experiential marketing agency, and we saw repeatable processes where we decided to build workflow automation to make it more efficient for our team, which is the exact same thing as the Boast story. So when we started to build the software and started to see that, we could build efficiencies through workflow automation, it was like, yep, now is the time. And then, the second component of that is growth rates and the pitch and the story, which we'll talk about a little bit later. But that's the first key, is like, that workflow automation and disrupting yourself. You see that story all the time.
Yeah, absolutely. Well, thanks for that. Well, great. Yeah, we'll get into it. Let me just, maybe set the stage for the discussion a bit. So as I shared that YouTube link, that's, you've created kind of a good body of work on this, I guess, this concept of creating a playbook for raising funds. So I think we'll get into the technical piece of that, maybe the second half. I'd love to just sort of take us first through the, kind of founder journey and, experience, funding, creating Limelight and where we, I guess, learnings from that. And then kind of get into, maybe you said you might have a couple of slides to share as well. So does that work? Yes.
Yeah, no, that sounds good for sure. Yeah. I think as you mentioned before, I gave, my first insights, I came from RBC Capital Markets. I spent 11 years there. So the early part of my career was at a big institution. And when you get into a big institution, I don't know how many employees, 88,000 employees at RBC, something crazy globally. So I was a little piece of the wheel that was this giant machine. And, I was doing trading, and I was very good at that role. And then when I left to do entrepreneurship, you come into this new realization where you need to be a generalist and do everything. And, I'll admit it was kind of like deer in the headlights at first. You're like, oh my God, where do I start? How do I get going? And how do I get the ball rolling in terms of really trying to get out of the gate here as an entrepreneur? And, there was some adjustments I had to make just because of the unstructured, day that you have as an entrepreneur. You've got a laundry list of things you got to do, and you got to figure out how to prioritize those and start knocking things out. And that, that was admittedly a challenge for sure.
Oh, for sure. How about with, friends and family, where they're kind of like, I don't know, Russ, you got this new startup thing, or you're pro in banking. Like, I don't know. How was that?
Yeah, you know what? And it's funny, even at my, you talk about how your messaging and your pitch and everything evolves over time. Like in the early days of it, I would go pitch to friends and family, and they were like, that's cool, and give you the thumbs up. And you're like, yeah. What is he talking about? He's crazy. You know what I mean? Because you just haven't toned it in. You haven't really figured out what your elevator pitch is. You haven't really even figured out what your product is, especially with what we were doing. We were selling an enterprise solution to Fortune 500 companies to try and track their live events or experiential marketing better. So talking to your friend and family who doesn't work in that space, they're like, I have no idea what you're talking about, but it sounds cool. So you really got to check your audience too, to gauge that feedback, because they might not get it because they're not the people you're intended to sell to. And that's another component of gauging that feedback.
Yeah, no, that's really tricky. You got to figure out who your true customers are. I mean, sure, as friends and family, at least, to your face, they're going to be positive, right? They're like, oh, we want you to succeed. That sounds great. But, the person's going to put their name on the line at their own company to commit to buy you, right? That's a whole other, process. And trying to understand what those people are thinking is tougher. So,
for sure.
Quick note to the audience: if everyone could sort of make sure the mute's on and videos switched off, that would be great. And also, feel free to fire us a couple questions. So we'll kind of watch the chat or the Q&A, and we'll try and tuck in a question or two from the audience as we progress, or maybe at the end. So that would be great to have engagement. But maybe just take us for a sec, Russ, through what Limelight is, just so people can visualize what it does.
Yeah, you know what? So the problem we were solving were for these experiential marketing campaigns that Fortune 500 companies run. Primarily, we sold into automotive, so auto shows, test drive events, and really about the attribution. So tying the leads or the participants or the attendees of these experiential events back into the CRM system for these large enterprises, so they could track multi-touch attribution in a sales cycle. It was a very broken process, and we had the domain expertise from my co-founder, who had an agency, who was disrupting himself, as I kind of alluded to earlier. And it was really about helping them track their spend. Does it make sense to spend money here? And you think about it all the way from, Blues Fest or big sponsorships, or even the campaigns where they're giving away samples at the side of the road. Like, how do you track the attribution of that? It costs millions of dollars to do those, but you have zero real data that you're collecting and feeding into your CRM to track the success of it. So that was our big thesis that we were solving.
Yeah, no, absolutely. I can see the appeal in hindsight. So I built a couple of companies in the marketing space as well. And the instinct around it would be, oh yeah, experiential marketing is very labor intensive and like chaotic. But if you're big enough brand, you do this routinely, there's got to be data that they can leverage. So, and that, nicely timed with, I guess, where the SaaS world was kind of coming to at that time, just really finding its footing. Great time idea, just hitting the market the right place, right? So awesome.
Exactly. Yeah.
And so looking at the starting point with that company, what you needed probably from pretty early on was the funding. So getting into that now. So just I'd love to get your thought on advising a founder today who had to raise capital right now. How should they think about the process? Like with that, I mean, do they need to already kind of know people with money, or they need to get lucky, kind of meet that deep pocket investor at a cocktail party somewhere, or a Zoom, as the case may be, and from then on, it's all gravy? Or, is there more like a systematic approach to this? Like, is there a playbook for raising fundraising?
Yeah, you know what, and great question. And I would pretty much say, I guess it depends on the experience of the founder as well. Like first-time founder, second-time founder. I think first-time founders, there's a lot of, ecosystem support out there in terms of, incubators, innovation centers, accelerators that can really help guide you in the right direction. Ultimately, if you're going to raise money from a VC, you need a pretty polished deck. You need a pretty polished thesis, go to market, addressable market, product, vision. And a lot of these early ecosystem communities can help you get there. And there's like the natural evolution, and Limelight took that natural evolution. We started off with a small friends and family round to give us enough runway to at least try out what we were doing. And that got us to a point where we got into an incubator where we could raise a little bit more money, and then, maybe leveraged an early grant program to get a little bit more. And we kind of used every single one as a stepping stone. Ultimately, we went to an accelerator. We went to Excela Prize, which is a B2B accelerator in San Francisco. They also have offices in Toronto, New York. And they were fantastic because, our thesis was, let's go to, the center of the universe for startups and see if they call us stupid. And they didn't. And that was the amazing part, because when they didn't, we were like, okay, maybe we are onto something. And they put money in for an equity stake. But again, it was like this stepping stone. And then really that was our catalyst. I would say was the accelerator. It provided introductions. It provided us how to speak right, how to talk to the VCs, how to pitch to VCs, the practice we needed. And ultimately, when we graduated the accelerator, we were able to raise additional capital from some of the introductions we got out of that, which again, gave us the capital to get to the next step, which was critical in our process.
Yeah, well, it's great to hear. I did an accelerator as well. And I thought for the same reasons you mentioned, like just, particular, some initial introductions to people I thought was pretty helpful. They just their own little mini ecosystems and people kind of cluster around it, right? So it sounds like they had some programming that was good as well. Is that like to sort of lay out some of the tactics too?
Yeah, the programming was phenomenal there, especially with some of the LPs they had there. So like Nick Mehta from Gainsight, which is a unicorn, he was doing sessions. Tian from Zuara, which is also, I think they're a $2 billion listed company. He was doing sessions on stuff. And, one of the crazy things I always thought was, it wasn't necessarily like groundbreaking ideas that they would share with you, but they would just tweak your thought process slightly. Mm-hmm. And also really cement that you're on the right track on certain things, which allowed you to move quicker towards it, right? If you've skipped the testing phase because you're going in the right direction, you can move a lot quicker.
Yeah, no, that makes sense for sure. I would agree. So, you mentioned a couple of names of folks that were involved, sharing their insights. How important is it to get names on your cap table in terms of finding the right investors? Is that key? What kind of investors do you want in the early stages? Like people that provide knowledge or connections, or just are a known name in the in the valley or wherever that can then kind of catalyze other people to get on board? What do you think? And is finding a lead investor a key part of that?
Yeah, great story. And my honest take on this is the names on the cap table provide trust that they've done the due diligence in your company, and therefore allow it easier for you to fundraise off of that. So, if you get a VC investor who's a well-known name and they put money in, it's a lot easier to go to somebody else and ask for money. And that works with angels too. It also works with advisors, which is where you have interesting advisors early on in companies where, it provides that level of social proof that the company's real, it exists, real people are thinking about the success of it. And again, it all comes back into that storytelling kind of aspect, and you need that story to tell to get people excited about what you're doing. So there is a critical component of it. On the flip side of that, I would also caution that majority of the time, these advisors, mentors, they have full-time jobs, they're busy, and they're really not going to provide as much support and advice as they even initially think they can, or that you want them to.
Yeah.
And that's just because they're busy. They're working full-time jobs and they don't have time to do it. So, lessons I learned is just around when you structure any of those agreements, if there's ESOP or shares involved, have very concrete, strict vesting guidance in that, even for your advisors, and they have to earn it, because just because your name's on the deck doesn't mean you earned it. What constitutes you earning that option and it actually vesting?
Yeah, no, key to think about some of those things. We'll definitely get into kind of ESOPs and how the cap table looks and dilution in a bit. One little tip I learned along the way was that when you're looking at bringing advisors on, it helps a lot if you can get the advisor to put money in too, because it might be, you say, I got this really smart person who knows about the space, and then another investor's like, but why haven't they invested? If they know so much, why aren't they putting capital in the company too? So I try, when I can, to try and find so the advisors that would have the cash available, that ideally angels themselves, and we want to kind of put their money where their mouth is a bit, because I think that really goes an extra mile with getting investors excited.
Yeah, no, absolutely. And you're absolutely right on that. Providing you can find the person who has the domain expertise that can help you, plus the cash flow to invest in an early stage company, which is not always the easiest thing to do. But if you can, sign it up. And, the way you can structure it is using some of the tools out there. You can use convertible debentures and safes where you can close these rounds on a case-by-case basis, where you're not building a syndicate to close a round. It allows you to kind of get these people on your cap table and show your growth and progression without sacrificing too much on that side.
Yeah, I think that's a good point. Like, I feel like safes have changed the game a little bit. So, for the audience's benefit, that's a financial instrument that isn't, where you don't need to price the round on day one. It's sort of a convertible debt. So you technically, someone's lending you money, but then it's going to turn into a proper valuation. It's going to turn to equity valued at a certain point down the line when the company gets valued. That, I think, now enables startups to bring people on kind of gradually, as opposed to from day one, trying to have to create a round where 10 people all agree to a valuation and away they go. So I think it's helping entrepreneurs, that kind of financial innovation a bit is helping. And I think that's just a tip for some, is that you can get your friends and family, you can get a key angel, you can get people kind of rolling and build it like a snowball, as opposed to trying to, once you get to your Series A, you gotta get the lead, and you got to build the syndicate around that lead, right? So just kind of an observation from my point that's safe or interesting that way.
Yeah, I mean, I would say pretty standard would be like pre-seed rounds would be on safes or converts. A seed round, you generally price. You don't necessarily have to. I mean, there's any combination of any top-ups or seed plus might be a convert, and then a Series A would be a priced round. So I would say that's probably a more traditional fundraising route.
Yeah, no, for sure. Well, I want to get in a minute or two. I'm looking forward to getting into, the journey you guys had. You have it mapped out, through those different rounds, and we'll do that visually. But just kind of a last question. First, picking up a thread you mentioned, which is storytelling. So again, my learnings, and that's where a lot of raising financing is a sales process. I mean, you're selling your product, but you're selling your shares too. It really comes down to it, and of course, a big part of selling is the story. So, love any just off the cuff thoughts as to what story startups might want to craft about their business. Any kind of, there's, just traditional stuff in selling is you got to create scarcity, you got to create urgency. Just how do you think about that? And I know much of your career has been in the sales side of things too now. So I'd love to get a sense for how you think about that with raising funds.
Yeah, no, great question. And I think you nailed it there, really about how are you creating urgency? How are you making the investor, the angel, excited about your story, right? And that's ultimately what it comes down to. You want to paint a picture of success that, really you want to paint a picture that, it's inevitable that this is going to work. And you can give me money or somebody else is going to give me money. But, the rocket ship's leaving and you need to get on now because otherwise you're just going to miss it. And that's ultimately the story you want to tell. And you have to paint that picture with unit economics and target market and the problem and the solution and your competition and how that all fits into your investor deck and your investor pitch. But every one of those slides really needs to tell that story. This is a rocket ship and you need to get on. And that's the FOMO that you need to create around it.
Mm-hmm. Well, how do you get investors to take that step? How do you convince them? I mean, if I'm an investor, I probably want to wait to the last minute. I'll see who else is coming around, and once there's enough folks there, well, then I'll take that risk. Reminds me of like Ray Dalio, a quite noted investor, advises to delay his decision as long as you kind of reasonably can, like get as much information as you can. So I can understand the investor's perspective, but like if everyone did that, no startup would ever get going forward. So what's your responsibility as a founder or fundraiser in the company? What tactics do we think about to address that?
Yeah, funny enough, I don't know if there's any finance guys in the room, but if anybody trades options, when you value an option, there's your intrinsic value and your time value. Time has value. And I think that's the key component that you need to understand about fundraising. As time goes on, your valuation of your startup is worth more. So time has value, right? That's the whole concept of it. So, if you're saying I'm raising today and I have a valuation of $2 million, in 6 months from now, I'm not worth $2 million anymore. So that message needs to go to that investor being like, if it's 6 months from now and you want to do due diligence for 6 months because you want to drag your feet, you can't buy in at 2 million anymore. It's now going to cost you 2.5. And that's the real basis of how you create this urgency. It ties back into being able to figure out how to value your company. What is the valuation on your early stage company? And there's no mathematical equation that's concrete, but you as a founder needs to be confident in the assumptions you make in that story you're telling, because you need to be confident in your delivery and your pitch to create that urgency for that investor to say, man, I want to invest at 2 million, not 2.5, because I know he's going to get to that 2.5 val in 6 months. So I got to pull the trigger now. And you need to create that to kind of get them over the line.
Yeah, no, absolutely makes sense. Well, why don't we, with that, why don't we kind of shift into, you had a couple of slides to share. And I think in particular, the one that lays out how you start that growing valuation from day one and where it builds, which I think will help people see how you can actually show investors that progression. Like I love that slide that you have. So maybe if you want to share that one.
Yeah, for sure. So I'm just going to share my screen here and go into a deck that I have. How's that look, Steve? Everything, you see that okay?
I can, yeah. It looks good on my
Perfect.
side.
Perfect. Okay. So this was the slide we were talking about, and this is actually the fundraising life cycle of my time at Limelight. So if you kind of go through this, you can see, at first we did a friends and family round. We raised common shares. Here's, our pre-money val, the amount of money we raised. This is what our monthly recurring revenue was, and this was our multiple. So the way these multiples work, it's 10 times 12 times 12.5 gives you your 1.5 val. And then we did an angel round, and that was common. And our revenue had spiked a little bit. You'll see kind of the life cycles of our multiples. They're all really relative between 7 and 8 times as our multiple, which kind of after the fact, I kind of noticed the trend on it. At first, it was my first time going through it, and I hadn't really thought about it, but this is what led to this process. And I think, I encourage all early stage founders to figure out what's your multiple? What are you worth? How do you create a valuation for your company? Because that's part of your story. It's part of your fundraising process. It's part of being strategic about fundraising, as opposed to just throwing darts at a dartboard and picking whatever comes up, right? You need to be a little more strategic about you go for it. This is when we went to the accelerator. They invested in a convertible note, which is similar to that SAFE. And here's what they did. And then we started to do some, debt, SHRED and the SHRED program and advanced funding on that, where we could take quarterly advances on it. And then we did some more convertible debentures.
Can I just jump in for a second, Russ?
Yeah.
At the start, I want to clarify a point for the audience. So, making that argument to investors, you say, well, the valuation is going to be different, next quarter than it is this quarter. But at the start, where you're maybe not valuing it because of using safes or convertibles or whatnot, you can still have measures within there by setting the cap, changes over time, right? There's still something somewhat tied to valuation and your sort of growth runway that creates urgency still. Is that right?
Yeah, exactly. And that's exactly what some of these early converts and notes did. So this was a straight common equity deal. And this was a convert into common, and this was a convert into common, and this was a convert into pref. And the way the cap works is if you have a cap of $5 million, once you raised your seed round, so your first priced round, the investors at this stage have a cap of 5 million. So the seed shareholders, the investors that came in at this stage, they're paying $10 million as the valuation. But the investors that came in a year earlier at a 5 cap, they get that discount on the round. And it doesn't convert from a debenture into equity until this priced round happens. Typically, it says a qualified transaction, which will be dictated in the convertible debenture language or the SAFE language that triggers the conversion event.
Right.
Yeah, so that's kind of the first piece of it. And it was interesting as you kind of get more complex and get into it. In August, you see how this converts into a preferred share. So that was our first institutional investor that invested in us. And that was venture capital. They were a VC from the Midwest, and they want preferred shares. And preferred shares and common shares are different in the fact that preferred shares are going to have different rights than common shares. Preferred shares might have a liquidity preference, whereas they will get their money out first in the event of a liquidation event. You sell the company, they get their money out first, common shares get anything left over. They might have drag along rights or tag along rights. There's different rights that are involved with these prefs, but liquidity preference is the main one that you typically see, where VCs will want to get their money out before the common shareholders do.
Russ, a couple of questions here, just coming from the audience. I'll try and gather them into
one.
The question is around, what does the company look like at each different stage? And so the very start, there's almost no revenue. Someone wondered, well, how do you value a company when there's like no revenue versus once you're moving on, what does the company look like at each stage? Like once revenues become more bankable or recurring, you can start to point to that number, and a lot ties to that. But maybe in the early stages, that's variable, right? It bounces around a bit. And so I guess the interest from the audience is like, what did the company look like at each of the earliest stages? In terms of customers, was there like one big name customer type of thing that drives it a lot, or what are some of the indicators investors are interested in and they're at the earliest stages?
Yeah, so great question. And this is that it ties back to something we were talking about earlier. Not all companies need to raise venture capital. Is your opportunity big enough? Is the niche big enough? Is the demand there? And that's a big question about it. Is it scalable? Is it professional service? Is it going to be a SaaS product? Those are all questions you need to kind of ask yourself around it. If you, in your thesis, is that you have a venture-backed solution you're building, you kind of have this minimum threshold of evaluation that it's worth your time. Because if you think about it, say you take 15 to 20% dilution at every stage. So at, at pre-seed, seed, Series A, Series B, Series D, if you take 20% dilution on each of those, after all that's said and done, you still, as founders, need to hold a certain percentage of the company to make it worthwhile. And if you give up too much of that too early, then the math doesn't make sense at the end of the day, which kind of sets a floor for this pre-money valuation at the early stages. And I would say that floor is close to that 1.5 million mark. You might debate it a little bit either way, but that's kind of the floor if you're doing venture-backed. Now, if you're doing a different type of startup where it's more retail or it's more not scalable, where you're not going to go through this, seed, Series A, Series B, Series D kind of funding, that changes that pre-money valuation and understanding kind of where you live in that spectrum. Not always easy to understand that at an early stage, but this is where that feedback comes from potential investors and presentations to kind of understand, am I the type of company that needs venture-backed money, or do I fit into a different category?
Yeah, no, good question. Good analysis on that for sure. And so where do employees and their equity come into this sort of cap table that's evolving as we see it? Like at what point are you making provision for employees?
Yeah, great question. So ESOP, employee stock option plan, is a key component, especially if you're going to go on this venture capital fundraising piece. The ESOP, which is typically when you start to get into talk to VCs, they want it to be 15% of the fully diluted shares outstanding. So 15% of the company is allocated to employees. And at an early stage, it's a bargaining chip for you to get advisors, to get mentors, and to get early stage employees where you might give up a percentage of the company because you can't pay your CTO market rates. You can't afford to pay him $200,000 a year. So you give them a hefty ESOP allocation that has vesting. The typical cycle is 1 year cliff. So nothing vests for a year, and then 3 or 4 year vesting cycles where the rest of the option package vests over 3 or 4 years. That's a typical cycle of what you'd see. And then at the end of that, all of that's vested, and then they can purchase that at the strike price. But it's key. And then with that ESOP, as you allocate that out, you might have a new VC come in on your Series A who says, hey, you need to top that up, and you have to re-up your unallocated ESOP. Could be back up to a 15%, could be to 10, really depends on who you need to hire and what those key strategic hires are. Generally, as you start to get down funnel, seed, Series A, if you're going out to hire anyone VP level, VP sales, CTO, CMO, CRO, that type of level, they're going to expect some sort of ESOP allocation to join your company.
Yeah, no, absolutely. That's helpful. Great. So definitely, the balance of our time, we want to spend a little bit on like non-dilutive financing and debt and that. But in the meantime, I wonder if there's other topics you want to kind of hit on, and then I think we sort of loop back into this cap table, maybe get to that piece, because some cases can come later, some cases early. I've got questions too, but let me know, because you've got this sort of flow of things. If there's other topics that you'd be great, you think, to insert at this point, Russ.
Yeah, I mean, I guess the biggest thing I try to emphasize people: fundraising is not a part-time job. You're not going to do it overnight. It's a full-time job. It's a full-time process, which becomes very difficult to do when you're trying to run an organization also, which is one of these balancing acts in it. So, we always kind of talk in Canada about how much money's floating around in terms of investments there are. So, this is the 2019 stats. I think the 2020 stats recently came out from the CBCA, and it was slightly down just because of COVID. But relatively, we're seeing great trends in terms of capital that's available, that's being invested. But on the flip side of that, the competition is fiercer than it's ever been. There's startups popping up everywhere. Everybody's trying to disrupt spaces. So really, you're competing at an even more competitive basis, even though there's more dollars flowing. That's the challenge with it. And then if we look at and starting to break it down into that early stage, like let's talk about the deals between 100K and $1 million. We're looking at just over 100 deals that were done in 2019 in that space in Canada. That's not very many. So now you have to think hyper competitive. You're now competing with 2,000 other companies, and you want to be one of the 125 that secures funding at that lower end of the market. And that's how competitive it is. So you have to think about it that way. Now you know what type of work and homework you need to put into your fundraising process. And if you put a half effort in, what do you usually get on an exam with a half effort? Think about it that way. You got to put that effort in to get there. The second component of how hard you have to work to fundraise, and I think it's funny because we always have the success rises to the top. So if you have amazing metrics, so you're growing 300% a year, you just went from 30 in MRR to 100 in MRR, you're going to be able to choose which investors you work with because your metrics are so good. But that's a rare occurrence. I mean, that's often who you hear who speak on these panels and public seminars. They're like, we put the guy who just raised a Series A who bootstrapped it for 10 years and say, tell me about your fundraising process. And it's like, well, it was pretty easy. One guy courted me and I choose one investor. And you're like, well, that's not real, because that's not the real thing. The real deal is you're working really hard to try and find someone who wants to invest with you. And Limelight fit into that category. We were what I call serial fundraisers. We were constantly fundraising because our metrics weren't that good. The market we were selling to wasn't that sexy. It wasn't a hot topic. There wasn't a lot of funds flowing into MarTech at that time. Yeah. And we had to work really, really hard to get our deals over the line. I'd say in terms of a bell curve, you have average metrics, and then you have people on the bottom end, but there's always going to be people at the bottom end who get deals done. And why do they get deals done? Because they have one hell of a story they're telling. And if you can tell a good story, you're going to have a better time raising money. And that's kind of the key message you really got to understand about the work ethic, the story, the pitch deck, and how you can get it across the line, even if you don't have the best metrics.
Yeah, I think that's a key point. Story is just so compelling. I would agree. Like the timing when you're raising those funds, you guys did a great job because, I was raising funds too for MarTech, and, they talk about AI winters and crypto winters. I think that was a MarTech winter where we were sitting in a bit. So great job on bringing those funds in for sure.
Yeah, and it was interesting. The whole spectrum of that time frame, like so MarTech's heyday was, call it 2005, 2010. There were MarTech funds popping up everywhere. They were raising fresh funds of, $100 million here, $100 million there. By the time 2015 came around, a lot of these funds were deploying only on follow-on. They didn't have any money left for new investments, or if they did, they were being super selective about who they gave that money to because it wasn't a hot space anymore. And we see this similar right now. AI, crypto, fintech, hot sectors, new funds being raised. You see Portage, they just raised additional funds, Radiance, FinTech Fund. You see these specialized funds that are early in their cycle. What was the new one? The Maverick that, Jim Orlando just raised, right? And that's $100 million fund. It's a new fund that just came up. Like that's the early in the life cycle of these funds where they haven't made an investment yet. They're going to start making investments. So you need to get in front of these type of companies or these type of funds that have fresh capital to deploy, because they're going to start to deploy that capital because the investors paid them to deploy this capital. The investors didn't pay them to sit on $100 million. The investors paid them to deploy it. And a quick background on that and how funds work. So typically if you raise a $100 million fund, you might say 40 million of that is going to new investments, and you're holding back 60 million of that for follow-on investments. And what follow-on investments means, it's like I invested in their Series A and I plan on investing in their Series B, Series D, Series E, and so on, until you're playing with the big boys and really can't play anymore because the valuations are in the unicorn kind of stratosphere.
Yeah, exactly. Good problem for us to have. Now, so that actually raises a point for me. I think entrepreneurs kind of questioned, to what extent should they focus on the, one or two or five investors that seem like the perfect fit for them, right? Like they're just teed up at the right time, they invest in their space, and just, kind of put their eggs in a small number of baskets versus keeping, kind of that longer tail, or, I think it was like a pipeline, right? Like you could use a CRM and keep a larger number of investors, in your orbit. What are your thoughts around strategy on that? How narrow or wide do you think founders should go?
Yeah, let me pop and I'll jump over to a different slide here in terms of our fundraising process. Oops, I think I went one too far. So this is really how I think about it. And, we talked about storytelling. We talked about, whenever you're storytelling and it's a sales process, well, what do you have in a sales process? You have a funnel. And the same principles apply for fundraising. What you're trying to do is have a large group of investors at the top of your funnel. Now, again, for those of you in sales, ICPs and buyer personas. So let's talk about what's an ICP. So if you're in MarTech and you're putting FinTech investors in the top of your funnel, well, I'll tell you right now what will happen. They're not going to buy because it's not the right industry. So what you want to do if you're selling FinTech is have 100 FinTech investors at the top of your funnel. So matches your buyer persona, matches your ICP, the fund the VC you're putting in at the top of the funnel, they invest at seed stage, because some of them will stay right on their website. We are a Series A lead investor and beyond only. Pitching them on pre-seed, not an ICP match, they're never going to convert, right? So try to get 100 plus matches to ICP buyer persona for that VC at the top of your funnel. And then you got to run them through that process from a sales perspective. And that's the storytelling part of it. You need to be asking them, saying the right things and telling the story to get them interested, because they're going to want to go through a courting period to understand who you are, your messaging, what it is. And often with some of these, that whole process involves, can I find a warm intro to this investor versus that cold outreach? An interesting one on that approach. Jason Lemkin did one of our, and I don't know if you know Jason Lemkin, SaaStar, he's got a huge following, right? So he did a speech at one of ours, and he's an angel investor himself and does investments. And someone asked him this question, and he's got more experience than I do, so obviously I'm just quoting him. But they asked him, have you ever invested in a company who reached out to you cold without a warm intro? And he says he's only done it once, is what he responded. And he said it was a absolutely perfect email. It was great. And it opened up the conversation, and he ended up investing in them. And his feedback on that was, there is nothing wrong with that, but the thought process he has is the ecosystem is still small enough that you should be able to find someone who can provide a warm intro for you to get there. I agree with that, but I also, if you are good at crafting cold emails, I have no problem with being the cold outreach person as well. Because I do that in sales. It's like, of course, if I can get to the buyer in a warm method, that's better. But at the same time, I'm not going to stop my process because I can't find it. So that's kind of how I look at it.
Sometimes you need to sell Microsoft, and if you don't know someone there, you just get it done. You find a way.
Just call Microsoft. Yeah.
Yeah. Definitely echo on that one. So just finishing, maybe answering my own question a little bit, like, I think I lean too much as a founder into like just visualizing, I can totally see so-and-so investing. I'm just going to focus on that person or maybe a couple others type of thing. But I really, people shouldn't discount that long tail possibility. Cold emails can work. Like, I'm doing a bunch of things because you never know where the money will come from. And I'll just share one short anecdote. I worked for a little bit with Clio, and they've been very successful now, raised hundreds of millions of dollars. But the first make it or break it investment in their company came through their spam filter. So one of the founders was just like cruising through his spam, literally, like, I'm not joking. Like, he's just sort of like, I wonder what's in here. It's been like a month. He's checked. I'm like, let's see it's in here. Got a cold outreach from an investor who heard about them somehow. It was like early days of SaaS in a way. It's a small world. And like, this guy just reached out, and they needed money. Like, it was rough. Like, I was like, again, it was make it break it when it came in. But, he wrote back to them and started talking, and this guy from Germany put up a bunch of money in, and then, the rest kind of was history in a way. I mean, there's lots of work along the way, but you you never know where that's, connection is going to come. So keep the net broad too. Like I think that's important.
Yeah. And I think that's the perfect segue into always be prospecting, which is, as you kind of get bigger, these VCs, they're not sitting there with inbound only. They're doing outbound too, because the VCs have theses around certain niches of their expertise where they see an opportunity and they're trying to find the right company that's going to win that space. Like these VCs are doing outbound, right? And that's exactly to your point. So the always be prospecting question is, when you're talking to these VCs and you have some connections, ask them general term questions like, do you see anybody talking about this space? Do you know anybody else who invests in this space? Can you make any intros for me? There's nothing wrong with these questions. These are sales type questions where you're always prospecting to get more people into your funnel, because to your point, you don't know where this money's coming from, but chances are there is an investor out there who has the same thesis and is trying to solve the same problem that you're trying to solve, but you just haven't been paired up yet. So you have to continuously search until you find that. So yes, absolutely. Great point.
Excellent. Great. Well, with about 12 or so minutes left, I really want to look at non-dilutive financing, because I think it's sometimes maybe overlooked by founders that don't understand it necessarily. The story is like, oh yeah, go get that angel investor. But like, there's a lot that can really help your cap table on that side of things. And obviously you guys are the experts on this. So maybe share with me, with us, how that looks when you sort of think to layer in, STRED credit financing, et cetera. I'd love to get your thoughts.
Yeah, I kind of look at it as an overall strategy of your non-dilutive financing, which is a key component. And if I layered in my non-dilutive financing and government grants on top of the chart we're looking at right now, it'd probably be 4 pages long, because I took money wherever I possibly could. A student grant, a co-op grant, a hiring grant, OCE, IRAP, like it went on and on and on, Export Canada. There's all these amazing grants out there that added up. I would say, STRED was the biggest component of this, but probably about $1.25 million at Limelight in grant money that I received over the 5-year period. That's a lot of money, but you have to go out and get it. And that non-dilutive also includes debt. And I think this is one of the misconceptions a lot of people have about debt at early stages. If you do modern finance theory, every Fortune 500 company has debt on their balance sheet, because they do something called your weighted average cost of capital to understand what capital is the cheapest for you to deploy. And generally, well, not generally, always for early stage companies, debt is your cheapest option. The problem is, if you don't have any revenue and you don't have any assets or inventory as collateral, no one's going to give you that debt. But if someone is willing to give you debt at an early stage, you should absolutely be taking it, especially with most technology startup companies now, there's no personal guarantees attached to it. So you can avoid, owning that personal guarantee, but still access debt to help you add leverage to your cap table to grow faster. And I think that's one of the key components that people need to be searching out is, how do I add debt to my tech stack or my capital table stack? Because that is the most effective way for me to grow my company. And with that, there is SHRED, and that's the most popular one. As I mentioned, from the government grant perspective, of the 1.25, I would say about 800 of that was from the SHRED program. So a massive program. It's a tax credit where you can get salaries back as cash for the R&D work you're doing, or you can get subcontractors, the contractor expenses back as cash if you're set up as a Canadian controlled private corporation. But with that, typically you got to wait 12 months, 15 months to get your refund. But that's 12, 15 months where you could have used that cash and reinvested it back in your company to grow faster. And that's one of the products that's out there where you can actually do quarterly advances on your SHRED and get that money on a quarterly basis and reinvest that quarterly so you can grow quicker. And that growth comes from, if you have extra cash to invest, you can hire more sales, you can hire more marketing, more developers. Instead of waiting a year to hire those people, you're hiring them now, which allows you to continue to accelerate your growth. And here's a little quick case study on it to kind of show you the valuation difference over a 2-year period. and how that actually works. Company A over here doesn't do any debt or any advanced funding for their shred and gets their first refund in Q2 of year 2. And then they start to grow at 20% after they reinvest their money. And they've got $289,000 in revenue after 2 years. Company B takes advantage of quarterly financing to get their money quicker. Their growth rate's 20% for more quarters, and their revenue is $343,000 after 24 months. And using those principles we were talking about, your multiplier on your MRR, Company A is worth 11.5 million. Company B is worth 13.7. So a $2 million valuation difference by using leverage, by using debt on your balance sheet early, allows you to grow faster. And I think this is a key component that I think a lot of people don't understand when they're trying to figure this out, that they should kind of look at when seeing that growth. Here's another way kind of to see it. You see Company B growing faster than Company A, and really how they're leveraging it.
Yeah, I think that's key. It's an interesting way to look at it. And again, many founders may not have looked at it that way, but I really think, yeah, it's about how you get in the future faster, how you accelerate. And it's amazing how capital can help you do that when it's thoughtful.
Yeah. And I mean, I'll pop one further and I'll go because I got a little bit more information. So non-dilutive. So what are the benefits of these non-dilutive financing options? So you're giving up no equity. You're giving up no board seats. There's no personal guarantees on it. You're extending your runway before an equity round. So again, this is for valuation stakes. If you're, at 50K in MRR right now, and you can take on debt, and that runway gives you another 6 months, and in 6 months from now, you're going to be at 100K in MRR. What are you worth more? Your valuation is worth more in 6 months. Again, that time value at 100K, and now you're raising money at a different valuation, which dilutes you less, which is why it's so important to explore these options. You can use these non-dilutive financing to bring forward cash for a key hire. Could be to optimize your capital structure, which is something we talked about, that the weighted average cost of capital. And it could be, again, as a plan B, which I also think is important, or securing financing options. You might be in due diligence with somebody about to close the deal. The investor's dragging their feet. They're not cooperating, because believe me, that will happen. And then you're exploring debt on the other side, and you're like, guys, I actually don't need your money. I just secured a $400,000 line of credit. We can talk later. And then you can put the brakes on and you can gain more control. And these are the things you need to do as a founder, is gain control of your fundraising process and not just be at the mercy of what they're calling the shots on.
Yeah, I definitely agree with that. I mean, you may think these are like tactics, or they sort of like, sort of cheesy trying to use tactics, but the reality is, back to your point about time, as a founder, your time is everything, right? So if you're not using every relationship you have, and, if there is a chance for funding there, you need to do everything you can to make it happen. Don't waste yourselves, you waste time on the funds and others that aren't in your space or don't look like they're a good fit, and they're, kind of nodding along the looky-loos, try and figure out who they are and qualify. But when you find those that should be a fit, then it's really all about the sales process and just making sure no one's wasting anyone's time, right? And that's a founder's job, to my mind, right? Investors are gonna take your time,
Absolutely,
because that's their job.
Absolutely.
Yeah.
So there's some other thoughts here. Just a time check. I know we only got a few minutes left. Were there any questions we wanted to kind of address before we jump out of it? I know there's a bunch more slides here, and you did put that YouTube video of this full presentation in there, so people can check that out if they want to dive into it even further.
Yeah, exactly. Yeah, we've been following along with the questions that have come in, so I think we've done a pretty good job on answering those. But audience, feel free to throw one or two more in there. I had a kind of one-off type questions. You mentioned that video actually linked that the EDC, Export Development Capital, can take on the risk of your loans. That was interesting. I don't know about that program. Do you have a second on that one?
Yeah, so I'll just go. I mean, here's one of my favorite charts here, because it kind of tells you where to go, because this is something that I struggled with myself when I was running finance at Limelight. But these are kind of the players in the space. And for venture debt, and some of these categories are further defined in some of these other slides, but these are venture debt players. Espresso, Firepower, Lighter Capital. These are the players for venture debt, revenue financing, Flow Capital, Tamaya. Both have offices out in Vancouver, so you might be familiar with them out that way. Kind of the in-between, I call it like the mezz debt, venture debt categories, BDC, Silicon Valley Bank, Comerica. Your senior debt, which is your banks, is Roynat, which is Scotia, BMO, TD, they're big five. And then the interesting part is EDC. So EDC will do loan guarantees for some of the senior debt. The problem is you need to bring them to the table. They won't go get them for you because they want you to pay more interest. And this lowers your interest costs if you bring EDC to the table. So you have to bring them to the table. So definitely keep EDC in your back pocket. Export Development Canada, they help you with access to sell in overseas markets. There's different grant programs and loan guarantee programs that they help you with.
Awesome, that's great. That's helpful. There's a question from the audience around lending against IP. Myself, I'm not familiar with that, but they phrase it as, if you're later stage patent application for software. Do you know about, again, that wouldn't have been exactly the area you guys were in, but do you know of anything like that?
So I think for lending against IP, you need to be definitely down funnel. So later stage, like you said, with patents, those patents have to be proven to have value. So you'll need an independent appraiser to value that patent, to put a value on it, to use that as collateral to loan against it. Typically, companies at that later stage, I would say, more fall into the category where you're looking at a more complex loan structure, where you're using all of your collateral, your revenue, your contracts, your financing as a full kind of collateral package in how you structure your line of credits. That's definitely the game that these guys play in when you're doing those large type deals.
Yeah, no, exactly. Okay, great. Well, that's brought us to the end of the hour. So, Russ, I want to say thanks very much, for your time on this and just all your insights. You clearly spent a lot of time, thinking about this and working in this space. So, great benefit to our audience today. Thanks very much.
Yeah, appreciate it. Thanks for having me. Please feel free to connect on LinkedIn. I got some other content on there on pitch decks, SaaS sales playbook, pipeline velocity playbook. Lots of content on there. Really, just trying to help early stage entrepreneurs grow and succeed.
Excellent. That's great. Well, we'll do that slide bean draw a little bit after this and maybe share it on social media. Again, sponsored by Boast.ai, which is very generous. And it's been a great talk. And we'll wrap it up there. And thanks everyone for joining. We'll talk to you later.
Thanks everyone. Take care. Bye-bye.